Good afternoon. Welcome to Prime Interest. I'm Perrianne B here in Washington, D.C., and these are the stories that we're tracking today. Who would have thought? Banks are writing their own legislation. That's what a New York Times article reveals. One bill in particular is carving out exemptions for trades from new regulation. According to the Times, the bill, which, quote, was essentially Citigroup's, sailed through the House Financial Services Committee. And Citigroup's recommendations were reflected in more than 70 lines of the House Committee's 85-line bill. While this probably comes as no surprise, the trend of banks currying increasing influence is getting noticed, which is probably not good for Mr. Diamond at all. An embattled hedge fund Mongol Stevie Cohen continues to face pressure for possible criminal insider trading charges. This after he recently had to pay $600 million to the SEC to settle civil charges. 4 senior executives were given subpoenas to testify before a grand jury. Many are looking at this case as a bellwether for the largely unregulated hedge fund industry. It seems the top dogs in this finance sector are not too big to jail. And finally, Japan's money printer-in-chief said he would do more to curb volatility in his domestic bond market. Since commencing the most aggressive QE program in history, the yen has more than 32% of its value relative to the dollar, and bond yields have spiked the most in decades. But the Nikkei stock index is also up substantially until recently. That is when it crashed an eye-watering 7.3% in a single day. It's a tough gig for central bankers who want to have their cake and eat it too. Here's what's in your prime interest. As you may be well aware, last week, Prime Interest producer Bob English and I attended the Bitcoin conference in San Jose, California. Now, we had the opportunity to interview Trace Mayer, investor, entrepreneur, and owner of HowToVanish.com, which is a website that teaches you how to attain financial privacy. Now, I asked him how Bitcoins fit into all of this, and here's what he had to say.
Bitcoin is the first decentralized digital currency. It allows you to send money directly person to person over the internet. And you're able to do so using just what's called a private key, and that's not tied to an identity. And so for people who want to protect their identity when they're purchasing things, they're able to use Bitcoin in a way that doesn't tie to an identity. So you don't, when you're ordering books off Amazon, they don't know what you've bought. And so it's not databased and archived and searchable for the entire future. With Bitcoin, you're able to keep that from appearing in the database.
And one of the things you talk about are these private keys actually being elements of speech. And how does that relate to, the Bill of Rights, the First Amendment and such? Yeah,
well, Congress shall make no law regarding the freedom of speech or of the press. First Amendment. Supposedly, we hold that dear in Western democracies.
Supposedly.
However, what about when people say things that we don't like them saying? The freedom of speech isn't made for speech that everybody agrees about. It's made for the speech that really upsets people. And Antonin Scalia of the United States Supreme Court, he recently said in an interview that money is speech. And nowhere is that more true than with Bitcoin, because with Bitcoin, it's just a decentralized computer program. And those private keys, they appear, 64 bits, so it's 64 characters, and they're pretty much random. And yet you can control millions of dollars with that, millions of dollars of value. You can send it to anyone, anywhere in the world, at any time. It can't be seized, it can't be frozen, it can't be confiscated. And yet, that private key, it's just speech. And Congress shall make no law regarding that.
And this seems so relevant with this AP, Department of Justice scandal that went on this week. Did you have any comments about the seizure of the AP documents?
Well, I think that we're seeing an overreach of the government in all types of areas, whether it's assassinating children for political speech, whether it's the IRS auditing and hounding and harassing people for political speech. It's this politicization of currency, and it's this overreaching of the state that's really causing a lot of faith to be lost in the fiat currencies, which are really just political currencies. And that's why I think this new move into math-based currencies, ones that you don't have to trust centralized authorities with, is gaining more and more steam and adoptance.
Well, and you talk about Antonin Scalia. This Bitcoin phenomenon, cryptocurrencies are relatively untested in the judicial system. Do you think we might see favorable treatment as cases come up and actually rise to the level of the Supreme Court?
I think it'll be very interesting to see how the courts actually deal with Bitcoin, because we have the FinCEN guidelines, which are just guidelines. They're neither binding nor determinative. The regulators, they've looked at Bitcoin and they says, well, it walks like a duck and it quacks like a duck, so we're going to treat it like a duck. But there are a lot of aspects to Bitcoin that, aren't like a duck at all. And those FinCEN guidelines, you can really make a lot of things at issues there as an attorney. And so if they do actually try to craft legislation that were to apply to Bitcoin or cryptocurrencies in general, I think it might be extremely difficult for that to pass muster. For example, it might be overly broad or it might be void for vagueness, both tests that would cause a judge to rule it unconstitutional. And then you've got also, freedom of speech issues that people could raise as defenses with this. So, I mean, it's just a new area of law and technology, and it's going to be interesting to see how the courts deal with it.
You also have a publication called The Great Contraction, and you talk about how in our system, our monetary system today, that assets and money can just evaporate. And I think one of the things that a lot of people like about Bitcoin is that it's decentralized and you can't inflate it. So can you talk a little bit more about your theory of economics? I read that you're a big proponent of Austrian economics, and why Bitcoin, if someone who believes in Austrian economics, who believes in those theories, why they would be attracted to a Bitcoin.
Well, when I wrote The Great Credit Contraction back in 2008, it was before Bitcoin even existed, and my website, Run to Gold, obviously a fan of that. The reason is because gold is nobody's liability. It's an equity-based asset. And it also removes the counterparty risk that you have when you're dealing with a bank. So with gold, you're protected against hyperinflation, and the counterparty risk, you're protected against that. Well, Bitcoin is a film that would go right above gold that adds a bunch of liquidity. You're able to send any amount of money anywhere in the world to anyone at any time. You can't email gold to someone, for example. But gold is always going to be there, so they're really a perfect complement. And Bitcoin, like gold, is an equity-based asset, and it's not subject to counterparty risk. So you don't have to worry about the bank in Cyprus or Washington Mutual or Bank of America or Merrill Lynch or Fannie Mae or Freddie Mac or any of these institutions failing and you losing the value that you have in your Bitcoin. You're really just more subject to the exchange rate risk, and if you can convert it into gold, then that's really what you need. So that's how I see it playing into this overall large theme of the Great Credit Contraction, where capital is burrowing down the liquidity pyramid into safer, more liquid assets, gold being the safety, and Bitcoin increasingly becoming more and more liquid as more merchants accept it and individuals accept it.
We had a chance to talk with Andreas Antonopoulos, and we talked about the multi-tiered payment structure that we have. We have the consumer level payment system where people buy food and gas with money, but we also have, for instance, US dollars used in a large way in international settlements. Is it possible for Bitcoins to become a global reserve currency? Is it big enough? Can it get big enough? And also retain, its ability to work in the smaller payment system.
Yeah, you can divide Bitcoins to the 8th decimal, so it leaves 2.4 quadrillion subatomic units. So, I mean, there's enough Bitcoin to have even the smallest micropayments in a, like a $500 trillion economy. So, yeah, Bitcoin could in its current state, absorb enough economic activity in order to do that. as far as it becoming a world reserve currency, I mean, maybe in 20 or 30 years at the most, we might have 5 different like reserve currencies: a dollar, a euro-ish based one, a South American one, and then an Asian one like yuan yen, and then, you know, an equity-based one like a gold/Bitcoin. And Bitcoin would be like a local currency for the internet, in my opinion.
What do you think it's going to take for the United States to lose the world reserve currency status?
Well, they can just do more of the same. But really, like, the United States is, in my opinion, is not going to lose its. It's got a very dominant position, and a lot of that has to do just with the geography. It's endowed with, you know, natural resources. It has everything it needs, a very highly educated populace. It's got energy, the natural landscape with the rivers and the tributaries and the Great Plains, 2 coasts. It's isolated. I mean, all of these things gives it a tremendous competitive advantage, and there's really no other region in the world besides perhaps Brazil that has a map that can lead to a potential competition with it. Now, all that being said, all empires end for economic reasons, and the United States is definitely doing more of the same in terms of, you know, running up a huge budget deficit, having to keep interest rates low, which will innervate the economy, and so it's and as it restricts those liberties and freedoms, it's going to restrict its economic productivity, and the people with the capital are just going to leave. They're going to go somewhere else where there's opportunity. You know, you got an unemployment rate in the United States, but you don't have an unemployment rate in Singapore. It's like 2%. Like, you want to go somewhere and make some money, like, go to Singapore. And it's nice. It's like San Diego mixed with Manhattan.
But we have seen a lot of volatility within Bitcoins. We've seen a lot of market corrections. Do you think that's going to start leveling out?
Not anytime soon.
Predicting fat tail risk is the death knell of many forecasters.
Yeah, I don't think so. I've been since like a nickel, even before that, in Bitcoin. I mean, I've seen a lot of ups, I've seen a lot of downs. There's still a lot of risk with Bitcoin itself. Cryptocurrency in general, it's this new species of currency, it's math-based currency. That's kind of what I'm talking about big picture-wise. And Bitcoin may not be it. You know, there might be some type of vulnerability that could, like, bring it down. But I think that the innovation is what's exciting, and that's what's going to be generating a lot of this wealth and opening new markets where people can take a payment from Nigeria and know the funds are good, so they can have Amazon ship the product out.
That was entrepreneur and investor Trace Mayer that we met at the Bitcoin conference last weekend in San Jose. Now, don't go away, because up next I have an interview with Ludwig Kincarini about the crowding of investment spaces and how this relates to systemic risk. That goes all the way back to long-term capital management. Then Bob English and I are going to duel over Bloomberg Gate and LIBOR. Stay tuned.
That was a new alert animation. It scared me a little bit.
There is breaking news tonight.
We are continuing to follow the breaking news.
Alexander's family crying tears of joy and embracing each other that justice has been rendered in a court of law.
Found Alive is a story made for the movies, playing out in real life. I'm the worst journalist in the world.
The White House soup of the day, my favorite radio guy in Fort Lauderdale, it's minestrone chicken sausage.
I want you to watch what we're about to do, because you've never seen anything like this on television.
Looking for celebrity gossip and the feel-good fluff? You won't find it here. But if you're looking for relevant stories, unique perspectives, and tough questions, tune into RT.
Long-Term Capital Management was a large hedge fund that nearly blew up in 1998. I spoke with Ludwig Kincarini, an associate professor from the University of San Francisco and the author of The Crisis of Crowding earlier, about this event and how it was similar to the financial panic in 2008. Let's take a look.
There are some similarities in the sense that in the long-term capital case, it was the case of a levered bank. In other words, a bank that borrowed a lot and invested, and they had complicated positions in a market that became very crowded, meaning that lots of people were doing the same type of trades. And what happened is once a slight shock occurred and that market didn't look so good, as people started selling, it put pressure on them and others, and with their leverage, it ended up causing them to either go bankrupt or require some sort of infusion of funds. And so that was their story. It was a slightly different story, but in 2008, a lot of these banks had similar complicated positions, similar types of short-term financing, lots of leverage, and when the housing market turned, as people sold, everyone was suffering and everyone sort of was in a chain to go bankrupt. So that was a similarity.
And what about the over-the-counter trades?
Yes, so the way long-term and many investment banks still finance themselves is through short-term repos, and a lot of the instruments that they invest in, the fixed income or bond type investments, they're not on exchange like U.S. stocks. They are over-the-counter, meaning they're traded from one bank to another by a phone call. And why that created a big problem in long-term's case, and even today, is because fundamentally, if we think we don't know whether the bank is solvent or not, we don't know how good their positions are. If they own IBM, we can quickly say, okay, well, they own IBM, so they've got to be at least worth this much, and we're kind of reassured. But if they have a lot of complicated positions that are trades with other banks that we're not aware of, then it's a guessing game as to whether they're solvent or not. And that was true in long-term's case. And rather than figure out a way to make that over-the-counter market more transparent or more measurable, we ignored it. And then we got to 2008, where a lot of the same problems occurred again, this time more in the housing over-the-counter trades, but nevertheless these type of over-the-counter trades.
Yeah, and it seems that these same issues still exist in our financial systems today. Do you have any solutions for the industry?
Well, one solution that I said in my book as well, The Crisis of Crowding, is to create some kind of computer system or exchange for most of the OTC contracts. And, apparently the CFTC is working on this, but there has been no formal announcement yet. So I think that already would do something, wouldn't solve all the problems, but it would make things better.
Well, let's say that the entire $700 trillion derivatives market became cleared, so there were no more over-the-counter trades. Does this itself remove systemic risk, or would we need other measures on top of that?
Great question. No, it doesn't remove systemic risk, but what it does do, and again, not only does it have to go to exchange, there would have to be other measures produced as well, not just that it goes on exchange, but that would at least help us have transparency. When a bank is in trouble, or even before a bank gets in trouble, we can see very clearly what the positions are and who they're owed to and what their net position is, so we can understand if they're truly in trouble or not. So that helps a lot. But we still have, there still could be systemic risk. So other things that could be done, again, I'm not saying these are the right things to do, but they certainly would help reduce systemic risk. One is to reduce leverage. So if all banks reduce the amount of leverage they take on, or have higher capital ratios, that would do it. Another thing that's very hard to control is that we have less crowding. In other words, we have less people doing the same trade. When many people crowd an investment space, it causes that space to become very vulnerable. That's harder to figure out what the rule is. I would say rather than a rule, it's more of a independent banks need to take that into account when they're making their trades, to measure crowding and make sure that they're not going into a crowded space where the risk is higher.
It's interesting that you say that the government and those involved with this didn't really know exactly what they were doing. And I interviewed David Stockman a few weeks ago about his thoughts on the bailouts in 2008, and I wanted to play for you what his comments were.
Okay, sure.
The idea that somehow the last standing gambling houses in Wall Street were going to fail, and then this was going to spread as a contagion to the rest of the Main Street economy is an absolute urban legend. I document it in my book. The Main Street banks were not in trouble. There wouldn't have been a run on the bank. There was no Great Depression 2.0 around the corner. That's just Bernanke's erroneous fears and false scholarship from the 19...
Yes.
That is funny. Yes, sorry?
Yeah, so Stockman, I mean, he believes that the bailouts were basically just a result of corruption and cronyism, and I just wanted to know what your thoughts were on the bailouts in 2008.
Yeah, he has a strong view. I'll say this. First of all, Dave Stockman nor I really can tell you the right answer. And the reason for that is because no one knows what would have happened. We just don't have that that sequence of history. So we don't know what would have happened. I don't entirely agree with him for this reason. There was some signs that the banks were in fact going to cause larger problems. When Lehman failed, commercial paper lending rates went through the roof. They went from something like 1% to something like 5%. And commercial paper is the way a lot of major U.S. corporations borrow money to finance their activities, their inventory, their short-term production. And so companies like GE and other companies were getting in trouble at the time because borrowing became extremely difficult. So to say that it wasn't linked to Wall Street, I think is incorrect. How big it would have been is hard to know. And so that's something that we all have to just take a guess on. Bernanke, there is one thing Bernanke had that he had studied history very well. And if there's any credit I can give him is to understand at least how these credit crises can get worse if something isn't done. So I don't agree with that. I think that you have to create a system where bailouts are not depended on. I agree with that. I'm certainly not in favor of governments jumping in every few crises. However, if you do get in a situation like we had, the choice was simple. You could do what Stockman says, which I think would have led to probably a year or two more of severe pain, or you could have done somewhat what the government did, and that probably would have at least tapered things off a little bit.
That was author of The Crisis of Crowding, Ludwig Kingerini. It's time for the Daily Duel, Bob.
Another week in the bag, almost. You got to get through this duel.
All right, well, what we have dubbed as Bloomberg Gate, it's still generating headlines. There was the scandal where Bloomberg reporters were allegedly spying on their customers. These customers included JP Morgan, Goldman Sachs, China, Turbo Timmy Geithner, and our beloved chairman himself. And it looks like our relentless coverage is producing some results.
Yes, prime interest gets results, finally. But according to the New York Times, some of the larger Bloomberg customers are getting together, and they're going to build their own chat network with Reuters and Market. Now, this group includes Barclays, Citigroup, JP Morgan, Deutsche Bank, and Goldman Sachs. Now, we got a leaked screenshot, and here it is, exclusively for our prime interest viewers. And there we have, hi, how are you? Yes, 5 minutes to fix. 3 months U.S. should be 0.27. Sweet net long from 0.25%. I do have to say, just for the RT lawyers on the 13th story here, this was a simulation, not an actual leak. But it does raise an interesting point, which is LIBOR, right?
Yeah, so LIBOR was a huge scandal. I mean, can you just go back and...
Sure. LIBOR itself is something that's been around for decades, and it's a means by which interest rates are set. Basically, 18 banks get together in London, and they tell each other, or the British Bankers Association, what their lending rates are from a day to 3 months to a year out. And then the top four and the top four bottom are subtracted, and then there's an average. Anyway, so very few banks have control over what's basically a $300 trillion market in derivatives and $10 trillion in direct lending.
And what's amazing was during the scandal, basically no one was holding these firms accountable to making sure that everything was accurate, what they were producing.
Yes, basically they could just tell whatever they wanted to, and that was one of the problems at the time. So.
Now, do we have any alternatives to LIBOR?
Well, we could actually use market rates, and the CFTC would like to see something like that done. Gary Gensler said, why not just use short-term repo market rates or the overnight index swap? It sounds complicated, but basically these are widely broadcast and well-known market rates, and we don't have to rely on bankers broadcasting things in secrecy.
And there's more people involved, so you're going to get more accurate numbers, probably.
Exactly.
Now, there was also... interesting story we found today. Amazon bought 3 blocks in Seattle, and they're in the process of planning out their new headquarters. And we saw some drawings of what they want to build. It's a 5-story glass bubble that will include enough room for full-grown trees.
I think that's all the time we have for this particular tech bubble story of the day.
Yeah, that's the picture from of the Montreal bubble. So we think it'll probably look something like that.
All right. Well, have a great weekend.
Well, it's been a pretty influential day. We learned how banks cozy up to congressmen to get favorable legislation passed. First you have to get along, then you go along. At least that's what Sam Rayburn said. And the Bank of Japan promises to play Atlas and hold up the Japanese capital markets on its shoulders. Maybe Bernanke can lend a fistful of dollars. And then Trace Mayer showed us how Bitcoins are carrying sway with math lovers who are tired of these politicized currencies. And Professor Kingarini explained the Fed's influence over the long-term hedge fund bailout. And then we finally turned the screws on Bloomberg Chat and revealed the competition. Well, that's all I have for today. In light of Memorial Day, I won't be back until Tuesday. But in the meantime, you can follow us on Facebook at facebook.com/primeinterest. And from everyone at Prime Interest, I'm Perrianne B. Have a safe weekend.